All right, gentlemen, thank you so much for this time, this opportunity to connect. This is one of my scariest topics. This and law always scare me. Counting numbers, dealing with the IRS, getting things set up. But it's also one of the areas that I found to be just absolutely critical to sustainability, to growth. It's key to how you expand with debt and all sorts of different things. So I'm going to turn it over to you, Joe and Sean, and we're going to dive into accounting fundamentals for small businesses on November 12th, 2020.
Thanks, Dan. Appreciate it. Yeah, this is a critical course, especially from our perspective. I'm Joe Benor with Catalyst Community Capital. We're a lender. We finance these types of programs and projects and businesses. And one thing that we see a lot is when requesting financial information from business owners, a lot of times you get a blank stare, or you're provided a stack of information that doesn't necessarily make sense. And on top of that is a request for a $100,000 loan, which is scary. So I think the purpose of this is to lay out just the framework and the basics for accounting principles and just certain things that you can do as a business owner to really get your books in order and to prepare yourself for whether it be funding or a loan request or just overall having a better understanding of your business and whether or not you're making money. That's the intent of this course. And with us, we have Sean Williams, a CPA from Southwest Florida, who's going to provide some great content for us here and go through all of these topics that you see listed right now. Sean, thank you for doing this and for joining us today.
Thanks for having me. And, you hit on a couple of really good points about knowing where your business is. Sometimes we just get into the throes of the day-to-day busy work that we forget to focus on managing our business and knowing, like you said, how much money we're making and where our opportunities for cost savings are. So hopefully after today, we'll be able to help folks out understanding the pinch points for their business and sort of how to understand the financial statements and accounting practices.
Awesome. And guys, I'm the worst at this is I'm supposed to be guiding the conversation and I turned it over slightly too soon. I'm Dan Oberski with Southwest Florida Impact Partners, Joe Benora with Catalyst Community Capital, and Sean Williams as the CPA firm that has been gracious to engage us. So he is going to be leading most of these conversations. I'm going to be asking questions as a business owner, and Joe, you're going to be leading the conversations along capital and financing, and I'm sure adding a bunch of great questions also. So again, thank you guys for diving into this with us.
Yeah, happy to be here.
All right, we've gone through some of the objectives, some of the discussion points. And Sean, maybe is this the first page that you want to start discussing high level items, or go to the next page here?
I think the next page is fine.
Oh, that's our pretty faces.
Just so you have those embedded in your memory.
That's right. If by chance you're only listening to this, this is a picture of two really good-looking, smart, intelligent people and me, who's just a chatterbox here. So I'll be moderating this, and we'll jump that page real fast.
He's the only man with hair of the three of us.
Exactly.
Hey, both you guys have really nice facial hair in this one. It's really, really good. All right, basic accounting principles. Now I'll move it back over to you, Sean, to dive into the hard stuff.
All right. So basically, I want to talk about an accounting system. And I'm not going to go through each of these slides. I know most everyone is able to read through them and understand this. But what I want to do is sort of give you some of the backbone. Some of the important things for keeping an accounting system is knowing where you are, knowing what your profitability is, knowing what your gross margins are. Because when you talk to bankers like Joe, they're going to ask you things like this. What's your profit margin? How many employees do you have? What's your markup on employees? And it's good for you to have a good understanding or a basic understanding of where these things are coming from or where you can find them from the information that you're given. If you work with an accountant, I want you to know where to look for certain things on your financial statements and help you be able to answer these questions that many people will ask you about your business, and that you should probably have fairly straightforward. I do want to make one point, probably the most important thing here on the slide is to keep your personal and your business finances separate. Be sure to keep separate bank accounts. Be sure to keep separate credit cards. If you want to know how your business is doing, it's very hard to do that when you have to go through every single thing that comes through your bank account or your credit card and discern whether or not that is a business or a personal expense. And it affects all aspects of your business, including pricing to your customers, if you don't have that information correct.
Hey, Sean, let me pause you just for 1 second. I think a lot of people, including me, probably started their business thinking accounting was more of a backwards looking item rather than a forwards looking item. And you referenced a couple points in talking through this around profit margin versus revenues. I have seen people, I've experienced it personally where I thought I was crushing it and knew how much money I was going to make, and my annual or my monthly income was this. And when I got down to it, my wife was looking at me wondering how much money was in the bank and why it wasn't as much as I thought it was going to be. And so, this forward thinking construct and working with an accountant or working with tax professionals to say, hey, I understand. Let's say I'm a coffee guy and I want to start my coffee company. And I know what the base cost is for each of these things. Help me walk through some of those questions that I should be thinking about and asking of, it's more than just what's the coffee grinds, what is it, and where would you start in that process?
Well, it's understanding your business and being able to explain it in a relatively simple fashion so that you know the inputs and the outputs. Ultimately, you're going to have coffee grinds come out of the other end. But what are all of the inputs that you need to do between acquiring the coffee bean, roasting it, maybe sorting, and you've got some waste in there. You've probably got some things that need repairs along the way. If your grinder has a dull blade, you're probably going to need to replace that blade. So you need to sort of understand what all of the costs are and all of the inputs.
That's good.
And the machines don't actually operate themselves. A machine is great, but you've got to have a person behind the machine that is going to operate it properly. Otherwise, you're going to have stuff going down the drain.
That's right.
So knowing where your costs are, what your inputs are, and really just being able to explain that if you need to on paper, but at least be able to explain it in conversation exactly what you do and what your inputs and outputs are.
That's good. So here's a mechanism. Up front, you could create a budget and then pass it along to your CPA, who might be able to poke some holes in it before you start a business in the red, right? So this is the forward thinking part of it, the startup part, before you get into the backwards realizing, oh fudge, I'm not where I thought I was. So ready for next slide?
Yes, sir. So the first thing to understand about an accounting system is that your receipts are your support. You need to have a good filing system before you can have a good accounting system. So for instance, not saying that this would happen to anyone listening to this webcast, but you could be audited by the IRS or by the Department of Revenue or by workers' comp or some other governing authority. So you want to be sure that you have substantiation to back up those claims that you make on those tax returns. So the easiest way to do that is by having receipts for all of these things and filing those in an organized fashion where you can put your hands on those receipts if you're asked to. So it's really thinking about your business process and really breaking it down. I go to Home Depot and I buy a widget, and it's a business expense. So I'm going to go ahead and either use my debit card or my credit card to make that purchase. At the end of the month, I'm going to get a statement from the credit card from the credit card or the bank, and I will want to have support for everything that's on that bank statement or that credit card statement. So all of those things are together. So let's say I need to return the widget 2 months later because it broke. I can find the receipt for that to take it back. If I don't find the receipt, they may be able to find it, but they may not give me the full value of that back as a refund. So your receipts are going to be really important for you to have substantiation for those. And I want to talk a little bit about cash and accrual, and know that cash basis of accounting is basically cash in, cash out. It is nothing more. That is your cash flow. So your beginning balance plus your revenues minus your expenses are going to be your cash on hand at the end of the period. So if you are on accrual, let's just say that I bill a client and I bill them, $100, but I say, you can pay me in 30 days. That is considered accrual method. That means that I have some form of an accounts receivable, or let's say a vendor gives me terms that I can pay off my credit card in 30 days. So what I do is that's a future obligation that I have. So I'll have an accounts payable for that credit card bill. That is a better way of looking at your business because it gives you a full picture, not just what went through the bank account, because I could have some issues behind the scenes on the collections or on paying my bills that may not show the full picture. And accrual really matches more of the timing differences that come up in cash. It matches the income with the expenses that are related to that sale. So just a little bit about cash and accrual there.
So let me chime in on that, because as a lender, an investor in companies, this is where you could start seeing some where it gets a little confusing for both the business owner and also the lender on the cash versus accrual, because you're going to be looking at receivables and how long should you book them before you consider them bad debt. So maybe you could provide a little color on that. What are kind of best practices for receivables and payables as it relates to time that you hold them on your balance sheet or your projections, 90 days, 60 days? At what point do you say, you know what, this is doubtful we're going to get this? Because when representing it to a lender and you're showing a balance sheet that has $200,000 of receivables, but half of them haven't been paid and it's 6 months, they're 180 days past due. As a lender, we're going to look at that and just, probably just discount or just completely just write off those and doing any kind of analysis. Can you maybe talk about that, what you see when you're working with clients, what you recommend?
Absolutely. So the first rule of business is, where is money doing the most for your business? And that's in your pocket, not in someone else's. So you really want to be very thoughtful on how you extend credit to customers. So you should have some form of a process that when you onboard a client, that you set out the terms that they're going to pay you within 30 days. If they don't pay you within 30 days, what's going to And the initial setup is the most important. I can tell you from experience, I've been doing this for 25 years. I know with my pretty face, you don't really realize that, but I've been doing this for 25 years. And what I found is that you'll have folks come to you and they will promise you the world. I've got 30 contracts. I've got 30 starts for you for this project. And they want you all in. And then you have a problem actually collecting on those funds. You can't ever collect on the entire contract because it was high hopes. And please, just when you're extending credit, don't go with what could be, go with what is. And cash in your pocket is, whereas a future benefit possibly has some uncertainty. And you want to keep in your business the most certainty as possible. You don't want to rely on hopes and dreams. Of course, we have them, but we can only do that with our knowns, and we can't do that with our unknown unknowns. We need to do it with our known unknowns, and we want to keep that risk to a minimum.
Yeah, and I would say that from our personal business practice, and every contractor is a little bit different, right? So if you're building homes, having a contract on a property that has a 180-day build is a little bit more difficult. From a commercial brokerage or a coffee shop or a small business, what I encourage people to do is show all of your debt as if that's 100% you have to do it, and show none of your maybes. It's going to give you the most conservative picture. And then I track all of my maybes to determine how good I am at selling, right? And determine like, hey, those promises, like maybe I shoot at 50% and I start to learn what that really looks like, and I can show a historical collection from that. Then after 5 years or 3 years or 2 years, if I show that to Joe and say, hey, look, I know I had this, I know my current revenue is this, but I also have collected based off of 56% on the last, $3.5 million over the last 2 years, he might be able to give me some credit for that, versus it having no bearing and having no predictive analysis. So one is accounting versus tracking is probably a piece of this, and how people are working through that.
Well, and I would also like to add to that it 56% sounds pretty low in a collection number. But if you can show the bank that you have actually done a credit check on them, that you've looked at the safety and soundness, that they've provided you financial statements, they might give you credit for quite a bit of those receivables if you've done your due diligence. Due diligence is one of those things that we come across when we're buying a business or selling a business, but it's also in our everyday practices. So if we do a credit check on that new tenant that moves in, if we have some form of a security deposit, if we are sort of taking that risk and mitigating that risk in some way, then it's more certain that we'll get credit for that and be able to use that as some form of collateral in the future.
Makes sense. It's good. Now, this is basic financial statements. Lots of people throw out terms like personal financial, balance sheets, income statements, cash flows, like a lot of terms that people aren't necessarily used to diving into. So why don't you break it down a little bit for us, Sean?
All right. So these are the most common. You have a balance sheet, income statement, and a statement of cash flows. So if you're a cash basis taxpayer or a cash basis financial statement, you're not really going to have a statement of cash flows. The other statement that I didn't list on here is basically a statement of the retained earnings. So that is really just an analysis of your owner's equity or your capital in the business. So a balance sheet is as of a point in time. So this is a snapshot. Just think of it as a camera. You just take a picture of year end or month end, and this is your financial position as of that date. It doesn't predict any future. It doesn't really show much of any past aside from how much capital you have and how much of that capital is earnings or from your own pocket. And it shows what your liabilities are. So on a balance sheet, the thing is that it always should balance. So the accounting equation is your assets equal your liabilities plus your owner's equity. Think of it as two sides, your assets over here, and then your liabilities and equity over here. The bottom numbers should be equal. So if I have $50,000 in the bank and I have zero liabilities, I should have 50,000 in equity in this business. And that's usually what happens on the first day of business when I put my money into the company to make that first contribution. I'm basically debiting cash and crediting owner's equity. And that should always, always, always be equal. If you get a balance sheet that doesn't equal, there is something wrong in your financial statements. So your income statement is basically your profit and loss statement, if you will. So it shows profitability over.
Hey, Sean.
Yeah.
Sean, can I pull you back for just
Yeah.
1 second? Because I think a lot of people get confused about this. They think equity is positive and liabilities are negatives. That's not really the full picture here to equal out assets, right? You're combining everything that you have and you have paid for or owe people on, right? Is that a simplification? Is there a more simple way to put it?
So here's your assets. Your assets are your future benefits. So if I have cash in the bank, I can spend that cash. If I have bought a piece of equipment, if I bought a vehicle, I have a future benefit from that asset. If I have accounts receivable, I have a future benefit to that future money. If I finance a loan, I have a future benefit to certain deductions in the future because of amortization. So those are assets are considered future benefits. Liabilities are future obligations. So if I buy a vehicle and I have a note on it, then I'm going to have a liability. Now, the vehicle I might have purchased for $30,000 and the note might be for $29,000. I put $1,000 down. So I use the cash and I have a note. It's going to show net of $1,000 in capital because I have $30,000 asset that's put on at cost. And I have a future obligation, which is the note of $29,000 that I have to repay over a certain period of time.
Awesome.
So that is your net equity is your net assets and liabilities.
Great. I appreciate the further breakdown.
Assets minus liabilities is equity, right?
That's right. So, if we go back into algebra class, we can move these things all over the place. And we can say liabilities equals, assets minus equity. But all of it is balanced and it is an equation. So it can be flipped and you can check yourselves many ways by knowing that simpler accounting equation.
I try to make the one recommendation as a business owner. If I'm going to invest in a company, I just say, make sure that the assets are greater than the liabilities. That's usually it. Make sure that the one number is bigger than the other number and you'll be doing okay. If it goes the other way, you might be in trouble, right? So try to keep what you have more than what you owe. And that'll keep you, that's a very basic way of looking at it without getting too overcomplicated, but yeah.
That's good.
Well, and let's sort of explain why you say that. Because, your business should be one of your assets. And you want to make sure that that asset is giving you some form of return on your investment. So if liabilities are greater than your assets, that means you've put more money into that business and you're not getting any return on it.
And
So-
you're,
Go ahead.
no, and I was going to say, as a lender, that means the likelihood of me getting repaid is much lower if the business does not continue to make money or earn any kind of cash flow to pay me back. Because if you default and the lender has to take over, all they have is the assets of the business to get repaid a lot of times. So if the liabilities exceed the assets, then as a lender, you're looking at it going, my worst case scenario is we're going to take a loss. And as anybody who's ever gone to a bank or a lender knows, they don't like taking losses. You know, we're not in the business to lose money on lending transactions. So
Absolutely right. Absolutely right. Which is a really good segue. We should be in business to make a profit. And you know, the income statement is where we can assess whether we are profitable or not profitable. And this is over a period of time. It could be a month, it could be a quarter, it could be yearly. And basically, it's how well you did over that period of time. And like I said, with accrual accounting, you're going to show all of your revenues, whether you've collected on those or not, and all of your liabilities or expenses, whether you paid those or not. And that is probably one of your best matching mechanisms to make sure that, okay, well, I had this job and it made this much money for the company, or it lost this much money to the company. And we can see somewhat, I'll just go briefly through the income statement. So at the top, you're always going to have your revenues or your income. Then you're going to have your cost of goods sold. Cost of goods sold, these are things that basically are direct cost to produce that income. So if I'm a builder, I'll have subcontractors, I'll have direct materials, I'll have workers' compensation insurance, I'll have all of these different inputs that are really a direct cost of doing that particular job. Then your expenses are more general and administrative. That's like your accounting function, that's like your office staff, that's your other things, building, rent, utilities, internet service, cell phones, all of that stuff are your expenses. So if you had not one job, you would still have all of those expenses. So it's seen somewhat of as a sunk cost, if you will. And you would have those whether or not you had income or not. So the income statement sort of shows your profitability. So your income minus your cost of goods sold is going to give you your gross profit. So this is what you are making per unit of widget that you produce. So if I build homes, I build a home for $180,000. My cost on it was $160,000. I should have gross profit of $20,000. Well, that $20,000 is what I have to pay all of my other expenses. So, and that could be for a month, it could be for a year. And usually a house is a longer term project where you're not going to have all of that stuff happen in 1 month. You're going to do it over 2, 3, 4, 5, 6 months even. And if you're going through a jurisdiction that has really horrible permitting, it could take you even longer before you're paid on those things. So
just put a pin in this for 1 second. I want to make sure others are aware of when you're starting a business versus buying a business and how you need to look at each of these things. The reality is when I start a business, my world and the type of transactions that I do, I have a 3-year horizon from my perspective before I break even. So my expectation is year 1, I'm almost always highly invested and at a loss of capital outflow versus capital inflow. My second year, I try to break even on operating expenses essentially versus revenue. And on my third year, I try and make what I lost in my first year. That's different than looking at purchasing a business or buying a income stream or contemplating something else. Those are essentially my investments in. It's almost like my buying time that I have. So generally speaking, these are important parts. So when we say that somebody, has to make sure they're making money, they have to either be aware that they're not going to make money for a certain period to get to a positive cash flow situation, or they need to have reserves set aside, because the reality is each business has a little bit different warm-up cycle or engagement cycle.
Yeah, that's a good point. Let me just add to that, Dan. When we're looking at businesses, is it like a lender or an investor? There's surprisingly, I shouldn't say that because I shouldn't be surprised about anything anymore, as much as we've seen over the years, but many business owners, especially people that are new and starting up a business and maybe they're only in business for a year, don't know how much money they make. Meaning they sell a product or a service and they don't know how to price that product or service properly, because they don't quite understand. When Sean, you brought up, it says on the screen, COGS, COGS, cost of goods sold, right? And there's a difference between the gross profit and your net income. And I think that's where a lot of confusion comes in, where it's, you have a cost to produce what you're producing and selling, that widget. You've got the materials, you've got the cost, there are direct costs associated with producing it, and then you sell it. So it cost you $4 to build it. You sell it for $6. You made $2 profit. Well, you didn't make $2 net profit. That's how much you made off that. Now you've got that $2 to pay for your staff, your office space, your phones, and all those expenses. And so really understanding what your cost is important, because you need to know how much gross profit you need to make based on how much expenses you have, how many operating expenses you have, right? If you know it costs you $10,000 a month to turn the lights on, you better make sure that you're pricing those goods at a point based on how much you project to sell, that it's going to generate at least $10,000. And like we said earlier, you're in business to make money, right? You're not doing it purely just to, break even or lose money. So you want to make sure that you know how to price your goods or services properly. It's important because we see a lot of times that people will mistake, they think they're making money, especially when you're on that accrual basis or you're doing some accounting and you think that construction's notorious for this because you're always kind of getting jobs and really not, you don't know how much you made until the job's done. And so be careful of that and know how to price your product. That's important. And we got to watch a little bit of time, guys. So let's maybe go through these slides so we don't get backed up here.
Yeah. Sometimes people just buy themselves a job.
That happens more frequently than I think many people think.
Yeah. So how do you figure out, like, why do I hire Sean, who's got 25 years of experience, versus George, who just came out of, the local school? Or like, how do you figure these, who you're choosing an accountant and what you're doing?
So you need to understand where the accountant fits into everything. Just having an accountant is not having the Harry Potter wand. All right, it's not magic. It's not going to make your business successful. It's not going to diminish your business, hopefully. It is there to assist you and to guide you and to sort of keep you in the rails. Think of it as, the bowling alley you go, and, when the little kids get up, they put the little guards up so that the ball doesn't go in the gutter, so that you don't deflate the ego of our precious flowers. So you want to be sure that you have those guardrails up so that we don't run off the road. So they're there to assist you, not to direct you. And they can only do it off of information that you give them. So if it goes back to anyone in data will tell you, garbage in, garbage out. So if you're giving them garbage to start out with, it's hard for them to give you proper guidance to give you a good result. So we need to be sure that the information that you're giving them is good, it's sound, it has some basis in reality, and that it's not just a bunch of hopes and dreams that we're trying to put into hard numbers.
That's good. And these are some guidelines and almost questions that somebody could use when engaging is, hey, I'm thinking about starting up. Am I this type of entity? Hey, what type of systems do you use that I should input, right? How do you guys form a budget? What do you think I should do to form my budget? How should I be paying my taxes, monthly, quarterly, annually? And get feedback, and you can almost gauge how they're responding to you and talk to a couple of them, right? Like,
That's right.
hey, you can talk to a couple. And as you reference here, this whole page should be something that people just take a clip, a picture of, and print off and utilize. Is ask them about your business versus their knowledge in other businesses, because there is certain ways that Joe does his business that's probably different than you, that's different than me.
Yeah, the simple user experience, I think, is a key point. When you're looking for accountants and interviewing potential CPAs or accountants to help you, finding somebody who's got industry experience, especially when you're in a kind of specialized field, right? If you're a contractor, you certainly want to find an accountant that understands the proper way to book, WIP, the work in progress, right? And, how do you job cost accounting and all that? There's certain things you want to know. And the finance business is the same thing, right? You want to find accounting firms that understand your business because they understand the nuances of that business and probably can give you the good, better feedback than others as to how you set up your chart of accounts. And we didn't really touch on it. I'll just say real quick, and Sean, you can expand if you like. Whether you're starting a new business or you have a business and just haven't done it yet, the accounting software that you decide to use, many people hear about QuickBooks. It's very popular. There's others out there. It's not the only one, although it's probably the biggest and most widely used accounting software. It's pretty user-friendly, but it's user-friendly if you have it set up properly. And so that getting that accountant involved early on to set up that chart of accounts, which is, this is what I'm going to classify this expense as. Is it an expense? Is it a capitalized expense? Is it something that's, an asset, or is it really an expense? And that accounting, setting up those books up front is so critical for somebody like me as a lender or an investor to get good quality information that I know is accurate without having to go in and reconstruct it down the road, right? So setting everything up front the proper way is going to save you an immense amount of time and money down the road. So investing a little bit up front to pay for a professional, to have the system put in place, get the accounting software done, get your chart of accounts set up right, is going to save you 10 times plus that down the road, trying to go back and figure out what that is, how'd you book that? So getting whether it's QuickBooks or Sean, you probably know other programs that are out there, getting that in place, get with an accountant, a CPA, set up that chart of accounts and get your books in place up front. And then they will walk you through how to book certain things, receivables, payables, revenue, what kind of income it is, all those things. Because then when it gets to me and we're looking at, making an investment or a loan, if I can get a nice clear picture up front and it's organized and it's correct, that goes a long way. Because I tell you, every banker and every lender or investor is going to, if they see this stack of information or this, it's Excel spreadsheet that doesn't make much sense and they're asking for money, out of the gate, you're already thinking this is going to be somebody they're probably not ready for funding. So it makes a big impression.
Yeah, and I will also say, just like having an accountant isn't a magic wand, having accounting software is not a magic wand, because it's only as good as what you have entered. And if your understanding is shaky, then the numbers are probably going to be shaky as well. So having someone at the front help you, like you said, get going the right time first is so important, because I've seen businesses that have had to go back and recast 3 years of tax returns because just the information was terrible, and that they had accounted for it improperly, and they were going for a loan, and the lender's sitting there saying, this stuff just doesn't make sense. How have you been able to be in business for 3 years and you have no income whatsoever? So we do find situations where we really do have to look at setting things up right the first time. And Joe, you hit the nail on the head when you said it's easier to do it right the first time than to go back and do it and fix it afterwards. So having that system is so important. And, you know, even if you just do a consultation with an accountant that you trust, going through what you're doing and whether that is making sense or not is so important. Just to have someone to bounce off ideas. And friends, family, they may not understand all aspects of your business, but you can also ask them, you know, hey, you started up your own business. What did you do? And you look at the people who are successful around you, and you'll find that they are more than willing to share some of their knowledge. They're not going to give you the magic potion, but they're going to share with you their experiences and what they found and what worked for them and what didn't. And I think that that's really important when you're looking for an accountant, to go with someone else that you trust. That way, at least you know that somebody else is using them and is very happy. One of the things that I always, you know, again, just like your customers will promise you the world and deliver half of it, be careful of your accountants that they're not doing the same thing. That they're not going to sit there and say, oh, I'll give it to you 3 days after you give it to me, you know, because something will come up, you know, COVID, where things change. And we can't always do that. So look at what they're promising you, look at what they are delivering to you, and just always, my mantra is that I cost my clients not one penny. I should be able to make them money. If I am a liability to them, then they probably need to find someone else. And I've developed my book of business in a special way that it's all been by word of mouth, and I only accept clients from clients that are current clients, referrals by current clients. So I've got more of a niche firm, but those clients send me clients like them. So if I've worked for 25 years on developing a book of business of A clients, then those clients will send me usually a client exactly like them. So if they are meticulous in their bookkeeping, if they're meticulous in their checkbook, they make sure that it's reconciled at the end of the month. They keep all of their receipts with their credit cards and their bank statements. They're going to send me a client that is just like that. So think about that with your businesses as well. So if you're a builder and you have a really good contractor that you're working with, don't be afraid to take a recommendation or a referral from that person. What you do want to be careful of is someone promising you 280 starts in a year, and then you don't know if they're going to pay you half of that or a quarter of it or whatnot. So
it's all good info. I just want to be mindful of the time on it. Managing cash flow is another one, like what you were just talking about there. I think it's important for business owners to know. Let's go into this next slide, Dan. Just understanding cash, because while accrual might give you a better picture of, you know, the overall financial health of the company, because you know what's coming in down the road, managing cash flow is critical, right? Because the ability to pay your bills without cash is not there, you know, so you're going to need to know that you have the money in hand to operate the business. You may have receivables that are coming down the road, but a lot of times they're not going to help you out when you have vendors that need to be paid today and employees that need to be paid. So Sean, if you could quickly go through some of the points of just getting, you know, understanding how to manage cash flow.
So yeah, your terms are extremely important. So if a vendor is offering you time to pay and they're giving you a discount if you pay within 10 days, look at the cost of paying that within 10 days rather than the 30 when it's due. Look at your timelines. Most small businesses will have a weekly payroll. So they've got to meet payroll at the end of the month. And if you are extending credit to your customers, say for 30 or 60 days, and one of those are late, then you might have a problem making payroll at the end of the week. So you need to understand the different timelines on your inflows and your outflows of money. So if you have 30 days set for your customer collections, where you want to be paid within a month of billing, then you should probably have some form of terms with your vendors as well around the same period, so that your collections will match your outflows. And again, employees, if they see any wavering or you want them to hold off until Monday to get paid, you'll probably not have that employee around too much longer. So you really want to make sure that you're able to keep the people that you have employed, but you also want to make sure that those folks are adding value to your company as well and not just dead wood. You do want to make sure that they're productive and they're making their salary, not just coming in and earning a paycheck. You want them, owning a part of the business. So paying those folks well, making sure that they get paid on time. Those are really important to keep good people within your organization. And same way with vendors. And I'll get to that a little bit here in your business concentrations. So business concentrations are basically, I have one client. Is that good for business? Probably not, because I'm very reliant on that one client to pay all of my other obligations. So it is a risky business because I'm basically putting all of my eggs right there in that one basket, that one person is going to sustain me for however long this endeavor is supposed to go on. So what I want to do is I want to diversify my portfolio of clients, and I want to make sure that not only do I have, the contractor and the subcontractors and the land developers and the other types of businesses as clients, I also want to have maybe some restaurants, maybe some bars, maybe some other clients, so that if something isn't doing well in the natural cycle of business, that other things will. And again, there's cost to doing business that are going to be there whether or not you sell products or not. So if I have one vendor that I'm buying from, that sort of puts me at an uncomfortable position because they can charge me whatever they want. And I am at their, I'm in between their fingers and not able to manage my business well.
Awesome, Sean. Now we've got our books in order. We've got an accountant. We've done budgeting in the past, and now we've done forward thinking. We've contemplated some risk. Now, how are we looking now with our actual financial picture when we put it all together? And that's our next part of our last phase of this technical assistance. And I think we've given a good picture in the past, and excited about this last portion here. So these questions aren't something that you just flippantly go through in life. These are ones that are intentional, action-oriented, and sometimes you got to be paired with somebody who understands them also. Right, Joe?
Yeah, I think so. These good questions, they're always good. Like these things right here are good starting points just to really do a self-assessment of the company itself. I mean, there's going to be a lot of times where you really have to ask yourself some hard questions. As it relates to your accounting, I think, the second one, do you appeal to financial institutions? Can you prove your business is or will be successful, and how? We get a lot of business plans submitted to us, and I always I smile a little bit. I've certainly done them myself, but you get the mission statement, you get this whole thing. It's kind of pretty pictures and whatnot. The reality is that what I want to know is, look, let's just get down to what we're here to talk about, which is, how are you going to make money? How are you going to grow this business? Who is your client base? Who is your customer? How do you know that this is going to work? I mean, a lot of times I think people go into starting a business with this idea that you have to be very, it's this kind of complicated thing. You have to put all these graphs and charts and all that together. And the reality is that most businesses are just meeting a need, right? I start a company because I see a problem or a need in the market, and I think I have a solution, and I think people are willing to pay me to help them with that, give them that solution. I want to build a house, I'm going to hire a builder. I'm a person that knows how to build houses. So I say, you know what? I think I could build this house and make some money because I know people want to buy houses, right? I make glasses, I make widgets, whatever the case may be. So a business plan is really, you see an opportunity in the marketplace and you say, I think I can there's an opportunity there to start a business around it. Now it's your job to explain to both yourself and your potential investors, lenders, how is this going to work, right? So these questions are really, surrounding that whole thought is, how much money do you need? What's the plan? How many people do you need? Do you need a location? Do you not need a location? You can see here, do you have any contributions from friends and family? Are they gifts or loans? Do you have formal contracts in place? So there's a lot of things that go beyond just like with the accounting side of it, which is like credits, debits, balance sheet. It's really the whole financial picture, right? And I think the purpose of this training is getting business owners, small business owners, whether they're currently in business or they're startups, in a position where they can be successful because they know about their company's financial position. Are they making money? Are they profitable? Are they growing? And if they're growing and they need capital, are you in a position, do you look attractive to capital providers like lenders or investors? If you flip to that next slide there, Dan, kind of a continuation of this. This is maybe Sean touching on this, like managing inventory, collecting accounts receivable, examining accounts payable. That goes to like the cash flow. Again, it's very basic when you look at things. How much do you have coming in? How much is going out? How much does it cost you to make something? How much are you selling it for? And then what Sean said earlier made a lot of great points about, understanding that it's better to have the cash in your pocket than to be owed something by somebody. And if you are going to be owed, we have this receivable out there. Who is the person on the other side of that, right? So try to limit that as much as possible. I will say, to a point that Sean made on a few slides prior about concentration risk. As a lender, if you're going to get financing and your primary collateral that you have is this book of accounts receivable, and that's a lot of businesses go for a bank to get a loan, and sometimes they can't get a bank loan, so they go to what's called a factoring company who basically buys the receivables. Your collateral is this future payment stream. You've done some work, somebody owes you some money. You want to be able to leverage that future cash now. Somebody owes me $100,000 2 months from now. I need $50,000 today to pay for my employees, my office, general operating expenses. I want to go and take that $100,000 receivable, pledge it to somebody as collateral, and then they're going to give me some percentage of that now. And so when I'm looking at a company who needs funding and they've got a $500,000 accounts receivable log, and that's one client or two clients, that's a lot of risk. Meaning, if I give you a loan against that collateral and that business goes out of business, I don't have anything, right? Because it's all tied to that one client. Just like if you own real estate, you own 10 houses, but they're all on the same block. If something happens to that city, that block, the value of all those homes are affected. You own stock, whether you own stock in one company or 10 companies, that diversification. The same thing applies to your balance sheet and what you're trying to leverage if you're trying to get financing. So, so to the point of this slide here, kind of assessing your situation, assessing it from the context of trying to get financing, investment. It is important that you do understand your overall financial position when you're going out for funding.
Good.
And
Sean?
I also want to make a point on this slide too, in managing your inventory. Make sure that it's inventory. Make sure that it is still in your possession. So you should be reconciling your inventory at least on a monthly basis when you close your books to make sure that that inventory is still there and still able to generate a future profit. I've seen too many businesses who think that they have inventory and then they go and try putting their hands on it and it's not there. So just make sure that when you are managing your inventory, you're actually managing your inventory and you're taking your perpetual numbers that are in your computer system and reconciling those to physical counts at some points to make sure that you do have that asset still available to you.
So just a summary from my perspective that I want to make sure, if you're sitting there thinking to yourself, I'm about to start a new business, until I listen to Sean and Joe tell me how hard it is to go down this path, it can be simplified, but I think it's also super important to realize sometimes there's better alternatives than the pride of ownership. Sometimes you make more money by working within somebody else's systems that are already in place. And sometimes you're better doing what you do and letting somebody else run a company. So if we can help people choose not to get into bad businesses, that is actually part of our goal. Is we want you to be able to step into a business that is profitable, that is productive, that is something that can be monetized when it's all said and done. You know, you cannot sell a company that's a job. It just doesn't exist because you have to replace that person. So if you've not been able to listen through what we're talking about and get to the place where you can see a profit in a company with the exclusion or exception of you being a part of it, then you don't have a business. You just have a job. And so, you know, I talked to somebody today who talked about starting a real estate brokerage company in residential real estate. And I was like, well, do you want 1,000 agents? Because, you know, the margins are so thin that you got to be ready to scale up. You don't just do that because you wanted to save $5,000 on your fees that you pay to an agency. And so I think, you know, these are just phenomenal conversation starters, thought-provoking discussions. But let's say now we've got our act together, we've got our books together, we've created a business, and we see some growth opportunity, or we want to buy a building. Now we're going to step in a little bit into where do I get the money? If I got a good company going, who do I go to? How do I get the money? What does it look like?
Yeah, that's always the question, right? Where do I get the money from? I got this great idea. It's going to be the next big thing. It's going to be the next Facebook, but I need $1,000 to start it up, right? Where do I go? So there's a number of funding sources to go to, and here are just a handful of the major categories. So, you know, Catalyst, my entity, you know, we are a mission-focused lender, Catalyst Community Capital, getting certified as CDFI. You know, we pretty much focus on, you know, underserved businesses or companies located in underserved areas that banks and more conventional lenders won't finance. But there's benefits, there's ups and downsides, pros and cons to each one of these. Everybody's familiar with the banks. They go to their bank. It's usually the first place that somebody goes. I've got an idea, I've got a company, I need funding. I'm going to go to my bank. Banks are going to give you the best terms if they'll do your deal. They have the cheapest cost of money, meaning they can give you the lowest interest rate. They have other services, checking accounts, you know, credit card processing. You know, obviously they have a lot of funding so they can grow with you. The downside is that if you're a startup, very difficult, almost impossible to get funding from a bank in the beginning. Prior to your second or third year in business, where you're actually starting to make money and showing a track record of making money, many banks will not do that financing. They just don't take that risk. They're just not in the business of taking risk. It's not a knock against them. They're regulated. They just can't do it. So now you go to SBA lenders as an example, but there's SBA, there's USDA, there's other lenders that are providing government-backed funding. The SBA for small businesses provides loans, or they provide guarantees to banks and lenders. So they're not actually making direct loans in most instances. SBA lenders are those lenders that are approved by the SBA to provide funding. They're more flexible. They will do startups because the government is providing a guarantee. I'm an SBA lender. I want to go out and originate loans. I'm going to give you $1 million for your business because your bank's turned you down. And the only reason I'm willing to take that risk is because I'm getting a guarantee from the United States government that if that loan goes bad, that some percentage of it's going to be repaid by them. The downside of SBA loans, personal guarantees, meaning you are signing personally on it, that if the loan goes bad and the business has no assets, like we discussed earlier, they're coming after your personal assets, not just the businesses. Typically, they're taking a pledge of all collateral, so receivables, real estate, inventory, all being pledged. And the process can be a little bit slower than your typical lending from a bank or another type of lender, because there's the government involved in the documentation and whatnot. Asset-based lenders, like I mentioned, accounts receivable lending and factoring, they're going to be the faster source of money. Not a bad option for a startup that's got collateral, not much track record, but they've got some accounts receivable they can pledge, or they've got some type of other asset, whether it be real estate, equipment. They can put that up. They will move faster. They're more agile, but with that comes a cost, higher cost of money. You're going to pay a higher interest rate and fees, but it'll get done fast. What you will typically see is in the life cycle of a business, the longer you're in business and the more profitable you are, the less you pay when you borrow money. The risk goes down, the rate goes down, the fees goes down. So always know going into it, the cycle of equity is, or cycle of capital in a business is typically equity in first, highest risk, highest return. Then as you start adding debt to it, you're going to lenders that are going to take more risk, so they want higher yields. And then over time, as you've proven out that your business works, you've got more assets, more collateral, and a predictable stream of cash flow, then you work your way to a point where you're getting the most attractive financing that's out there, which is typically going to be bank or that type of lending. The final category or final type of lender, CDFI, that's one of what I would say are community-based lenders, community development-focused lenders like us, where you are a startup, it's a minority-owned business, or it's a business located in a low-income area that historically has had a hard time getting funding from a bank or other source of capital. That's the focus of community development financial institutions, or CDFIs. In addition to funding, another benefit is the technical assistance, like this presentation we're doing here. CDFIs will work with businesses, not just giving them loans, but also giving them help. Sometimes the worst thing you could do is give somebody money with no assistance beyond that. Your funding could be the demise of the business. If you give somebody capital with no guidance and they lack, an understanding of what to do with that funding, they can spend themselves into a position where now they owe money and they have no benefit of that money that they received. They didn't get any more assets or grow the business. So
I just pause there. A reminder that you can't make the best decisions under pressure. It just doesn't work. I've always seen that my guys and my companies, once they hit stability, their business and their book of business becomes far more effective and efficient, because now they're making good decisions. And debt is just one of those things that can become a huge burden on somebody's shoulder, where they're preying on a contract, they're hoping for a deal, they're cutting their margins too thin, and all of a sudden it can force them faster into a bankrupt situation than even before. So, confessions of a guy who's been in business for the last 20 years. Our newest business is 9 years old in October this past month. And we have had a credit card that's guaranteed by that company only for the last 8 months. So it took us almost 9 years, or 8.5 years, to get a credit card that wasn't personally guaranteed by Dan Olberski. And it took, 5 years of being in the business for me to fund a startup of a company before I was able to start our own brokerage company. So debt, I know people love running towards, and it's, an incredible leverage tool, but we tend to think super short term and forget about the implications of it long term. But to your point, Joe, on CDFIs, entities like Southwest Florida Impact Partners are nonprofit, for-profit, that's intended to come alongside people who want to get into business. Like business is a spectacular way to stabilize communities. It's a spectacular way to stabilize families. And so you've got access to Sean, Joe, and myself when you're considering all of these different types of things. And so I'm just going to pull that window up. Again, Joe Benora with Catalyst Community Capital, Sean Williams and his CPA firm. You got to know one of his friends, though, to become a client of his. But I promise you, yeah, I promise you, he is also gracious and generous with his time to help guide you. If you are not a friend of a friend, it doesn't mean you have no access to Sean. And then myself, we've got 5 partners in Southwest Florida Impact Partners, capitalizing and investing in the Fort Myers area for business startups and capital investments. So, gentlemen, any last comments or further things that you guys want to make sure that are set out to the individuals that have taken the hour to listen to this presentation?
I'll just make one last little pitch, and this is for the 3 of us here. I think that we all live by the mantra of feed a man a fish, he eats for a day, teach a man to fish, and he eats for a lifetime. And I think that that's what we're trying to do here is give folks the information to make an informed decision so that they are not at the behest of someone else. Making sure that they're able to look at their financial statements, understand them, and understand whether their business is worth continuing on, or whether, like you said, Dan, it would be better just to work for someone else. But if I've worked for someone for 20 years and I think that I can do it bigger, better, faster, then that is entrepreneurship at its core. And we shouldn't be afraid to do that. But just know what you know and seek help when you don't understand fully. And I think all of us here are willing to share our knowledge to help others become successful.
Awesome. Really appreciate your service here, Sean. Joe?
No, I mean, echoing what you said and what Sean said, I think all you can do is just learn more and more. I think, it never hurts to have a better understanding of all aspects of the business. I've been self-employed the majority of my career. And I can tell you that you're constantly learning. I'm constantly learning. And so, presentations like this, leveraging the people that are on this presentation, if you have questions, or, if it's not an accounting related question, it's something else, we can certainly refer you to other people in different areas of expertise. But, this is a good first step. If you're thinking about starting a business or you own a business, the fact that you're committing time to, watch this and learn from this presentation is a good first step. So thank you, Dan. Thank you, Sean, for doing this. Much appreciated.
Awesome. And just if you're watching this, Joe has an entire library of similar around law and a variety of other things that we're building on. So ask him for more content and have a absolutely wonderful day. And thanks for watching.
Thanks, everyone.